Hello and welcome to the Morningstar series Why Should I Invest With You? I'm Emma Wall and I'm joined today by Felix Wintle, manager of the Neptune US Opportunities Fund. Hi Felix.
Hi Emma.
So people have been saying it's difficult to find investment opportunities in the US market, but your fund is 100% invested, so you probably disagree with that.
I would disagree with that, yeah. We find opportunities abound in the States. One of the lucky, I consider myself very lucky to be a US investor because there's always something you can find to invest in, lots of themes, lots of great companies. And the same is true today. Clearly there's lots going on at the macroeconomic level with commodities falling aggressively over the last 12 months, for example. But that notwithstanding, there's plenty going on in other sectors, healthcare, discretionary, that we find really exciting. So yeah, there's no paucity of ideas.
And your fund is unconstrained. That means that it looks very different from the benchmark, and that's a very positive thing because it means you can move throughout the market scale and throughout, as you've mentioned there, sectors. Where are you seeing the opportunity at the moment? Is it in the small caps, mid caps, large caps?
Well, we tend not to look at it too much by market cap, but rather by sector. So our investment process is really about finding opportunities from our sector research, and we've got actually a very high conviction view at the moment in terms of where you should be invested. And we have no energy, we have no utilities, we're massively underweight industrials and materials, but have big overweights in healthcare, consumer and technology. And that's the part of the market we really feel passionate that people should be concentrating on. And indeed, I know lots of investors look to trackers when they look to get their US exposure, and we really feel strongly that now's the time not to be in trackers because, as you mentioned, if you compare our top 10 holdings with the S&P top 10 holdings, they look completely different. And in actual fact, only Apple's the one stock in common. But there's lots in there in that S&P top 10 which I just don't think you want to be owning. Stocks like Exxon, stocks like GE, stocks like AT&T, very old, really like old industries, really, sort of yesterday's industries. And we feel very confident that you want to be selective now and not just have a passive approach.
Because the market has changed. It's not like the first couple of years as S&P 500, indeed the FTSE 100 started to rally, where basically everything came up together. I mean, 2013 was an incredible year for you, 30-something% returns. Now the market has changed. It is going to be more choppy, it's going to be more volatile, and it's as much about leaving out the stuff you don't want as picking the winners.
I think that's exactly right. And it's funny, we went through a period, you're absolutely right, 12, well really from when QE started, so round about, I mean particularly 2010, 11 and 12, what we found was that really when QE was at its height, and what happened was QE was a rising tide that lifted all boats. So everything went up at the same pace and everything went down at the same pace, and it was quite a volatile time. But being selective at that time didn't really add much value because what you really want to do is just have exposure rather than be selective because the stock correlations were very high. As you rightly say, so that's now changed. We're in a new stage of the market, new paradigm for investors, and that's really driven by one, QE ending. Well, QE ended last year, as we know, about 12 months ago. And as we look forward, we've now got rate rises, and we haven't had a sustained rate rising cycle since the early 90s. So what does that mean? And are people prepared for that? And our conclusion on what that means is you've got to be in sectors which can handle a rate rise. You look at sectors which are really struggling at the moment, like commodities, and we know that with a falling commodity price and a rising cost of capital, that's a disaster for these stocks. And for example, in the US, Caterpillar recently had a big corporate restructuring. Stock was down 10%. Glencore in the UK is a perfect example of that. Very levered to commodities, very high leverage. Their debt pile's twice their market cap, and that stock's down, what is it, 77% year to date, something awful like that. So it's very, very real, and this new market backdrop creates winners and losers, and that's manna from heaven for active managers.
Felix, thank you very much.
My pleasure.
This is Emma Wall from Morningstar. Thank you for watching.